Gold prices have been breaking records over the past several months. At the start of 2025, gold was trading around $2,690 per ounce. By late January 2026, it surged past the $5,000 per ounce mark for the first time in history, briefly touching levels as high as $5,500 an ounce. This represents a rise of nearly 86% in just over a year. At the same time, the US dollar weakened, with its index falling to multi-year lows. But just as President Trump's announcement about changing the Fed chair shook the markets, gold and silver fell sharply from their record highs. Even so, gold prices are still much higher than they were at the same time last year. So, in this video, we'll break down the key reasons behind the massive rise in gold prices. Over the past year, several forces have pushed the gold to record highs. One major reason behind the surge in gold prices was Trump's trade policies and global uncertainty. Last year, Trump announced a series of tariffs on several countries that he believed were unfriendly to the United States. But instead of calming markets, these tariffs shook confidence in global trade and stirred fears of a broader trade war. This uncertainty made investors worry about stocks and currencies, and pushed them toward gold. Recently, Trump also threatened fresh tariffs on 8 European countries over disagreements linked to his proposed takeover of Greenland. These emerging diplomatic tensions between major economies like the US and Europe also caused the uncertainty, which pushed even more money into gold. But it wasn't just Trump's trade policies that fueled the gold rally. Around the world, wars and conflicts also added to the sense of fear and instability. The war in Ukraine and Gaza contributed to growing global instability. At the same time, US seizure of Venezuelan President Nicolas Maduro also pushed the gold price to record highs. The next big reason gold prices soared was the weakening US dollar. The US dollar index, which measures the value of the dollar against a group of major world currencies, fell sharply in 2025 and early 2026. By late January 2026, it had dropped to around 96, a level not seen in 4 years. The slide came even as President Trump insisted the dollar was great. Markets told a different story. Even though the dollar remains the most widely used currency in the world, its global footprint is shrinking in a meaningful way. One key measure of dollar influence is its share of global foreign exchange reserves. According to the latest data from the International Monetary Fund, the dollar's share of global foreign exchange reserves fell from 57% in early 2025 to around 56% by late 2025. This share was about 71% at the beginning of 1999. At the same time, the share of euro holdings in the allocated reserves increased to 21% from 20% in the same period. This means central banks are holding a smaller percentage of their reserves in dollars than they used to. While the dollar still dominates, the trend shows a gradual shift as countries diversify their holdings. In addition to its declining share in global foreign exchange reserves, the US dollar has weakened noticeably against other major currencies over the past year. The Swedish krona, Mexican peso, Swiss franc, and euro all gained notable ground against the dollar. Among them, the Swedish krona strengthened the most, rising by over 20%, followed by the Mexican peso and the Swiss franc. Central banks around the world are also buying large amounts of gold. This isn't regular investment buying, it's official buying by nations that hold gold as part of their country's savings and reserves. When central banks increase their gold holdings, they are reducing reliance on foreign currencies like the US dollar. And when many countries do this at once, it creates real demand that pushes gold prices higher. Another major reason gold prices kept rising was the increasing tension between President Trump and the US Federal Reserve. Trump openly criticized Fed Chair Jerome Powell for not cutting interest rates quickly enough. Trump pushed for lower interest rates to offset the potential economic slowdown and rising consumer costs caused by his aggressive tariffs. Meanwhile, Powell remained cautious, worried that cutting rates too soon could reignite inflation. He resisted calls for drastic rate cuts, emphasizing that the Fed's primary responsibility is to keep inflation under control. This difference of opinion made investors nervous, as it sparked concerns that interest rates could be set by political considerations rather than economic indicators. This concern prompted investors to turn to gold, which is considered more secure. This state of uncertainty reached a critical point when Trump announced his intention to replace Jerome Powell with Kevin Warsh as the next Fed chair. This announcement led to a sudden fall in the prices of gold and silver, and the dollar briefly strengthened. However, even after the fall, gold prices remained far higher than last year.